Home Depot just hit its lowest stock price in a year. Not because of bad management, not because of a scandal, because of a war 7,000 miles away in the Persian Gulf. And if you think that connection sounds insane, give me 6 minutes. Because by the end of this, you'll never look at a hardware store the same way again. Here's the chain, and it moves fast. Oil hits $100. Gas prices jump overnight. And the moment that happens, consumers freeze, not dramatically. Quietly, they postpone the kitchen remodel. They delay the bathroom renovation. They look at their budget and decide, not yet. That's Home Depot's entire business model. Deferred. But there's a second hit, and this one is more structural. Rising oil pressures, inflation expectations. That pushes bond yields up. And bond yields are already the reason mortgage rates haven't come down. Every new spike in oil is another reason for homeowners to stay exactly where they are. Home Depot doesn't sell oil, but it sells to people who own homes. And right now, those people are not moving. The war made this worse. It didn't start it. For 2 years, the American housing market has been essentially frozen. Here's why. When rates hit 7%, tens of millions of homeowners who locked in at 3% made one rational decision. They didn't move. No move. No new kitchen. No new deck. No contractor. No Home Depot. The numbers show it. Last quarter, revenue down 3.8%. Earnings per share dropped from $3.13 to $2.72. This quarter, analysts expect another 3.9% earnings decline. This isn't a company in freefall. It's a company trapped in a waiting room, waiting for America's housing market to unlock. Wall Street is genuinely split on this. UBS says buy, with a price target of $450. That's 43% above today's price. Their thesis: the pent-up housing demand is real, and when it releases, Home Depot captures everything. Wolf Research says outperform. Target $414. Same logic. But Zacks just issued a sell signal. Their argument: even at a 52-week low, the stock is still trading at a premium to retail peers on traditional valuation metrics. You're not getting a discount. You're getting a company priced for a recovery that hasn't arrived yet. Stifel says hold, waiting to see. This is a real debate, not noise. And understanding the gap between those views is more valuable than picking a side right now. While everyone stares at the stock price, Home Depot is quietly making its most important strategic move in years. April 6th, they appointed a new chief technology officer. Her mandate: rebuild their entire digital infrastructure from the ground up. Why now? Because Home Depot is repositioning around one specific customer: the professional contractors, builders, tradespeople, the customer who spends 10 times what a regular homeowner spends and doesn't stop when consumer confidence wobbles because they have commercial contracts. This customer doesn't care about mortgage rates. They're building regardless. And next fiscal year, even with all of this uncertainty, analysts project Home Depot's earnings growing 8.8%. A stock at a 52-week low with 8.8% projected earnings growth is a very different story than a company in decline. That's a company repositioning. Home Depot isn't just a stock ticker. It's a real-time reading on 70 million American homeowners. When it rises, people are buying, building, investing. When it falls, they're waiting, anxious, holding their breath. Right now, they're waiting for rates to ease, waiting for the war to end, waiting for the right moment to finally do the project they've been putting off for 2 years. That demand is real. It's piling up like water behind a dam. The question isn't whether that dam breaks. It's when, and when it does, the company sitting on the other side of that decision, with $314 billion in market cap and more than 2,300 locations, will be exactly where it's always been, ready. If this breakdown gave you a new perspective, drop a like and subscribe. And let me know in the comments, are you buying the dip or waiting for the dam to break?